from Long Island, New York asks, "Hey, Peter, I'm wondering why there are so many technology companies like Google, Apple, and Facebook in California. Because California is a state with a huge government and a lot of regulations and taxes."
Well, one thing, California does have some things going for it that helps to kind of balance out some of the taxes and regulation. You've got very nice weather. Successful people enjoy the California lifestyle, and so they're kind of reluctant to give it up. But I think more and more people are making that decision. But the more important factor is that California wasn't always this bad. The regulations and the taxes weren't as high back in the 70s, back in the 80s, as they are today. And so that's when a lot of the technology industry really began out in California, particularly up in the Silicon Valley area. And so there already is a lot of talent, there already is an infrastructure out there that was very conducive to the tech industry continuing to expand. So California is succeeding more as a result of its prior glory. I think what's happening now is hurting the technology industry's further growth in California. And I would expect that more of the innovation will increasingly come from outside of California and outside the United States as more and more states continue to turn up the heat on the entrepreneurs with more regulation and more taxes. So we don't want to say, hey, we still have a lot of success in California, so taxes and regulation aren't bad. We have to realize that the success began when taxes and regulations were lower, and we would be a lot more successful both in California and as a nation if we had fewer regulations and lower taxes, which would mean a lot less government.
Dan in Los Angeles, California asks, "What is your opinion on the 10-year Treasury short-term, 12 months? I'm currently refinancing an apartment building and the lender seemed to drag their feet and didn't lock my rate. I'm hesitant to follow through now and wondering if I should just wait."
Yeah, well, it's hard to say what's going to happen in such a short period of time. We have had a big drop in the price of the 10-year and a corresponding rise in 10-year yields. They got as high as about 2.2 and change. So whether or not it might be better to wait and maybe we get a dip back down below 2%, maybe 1.8, 1.9, I don't know. I mean, that's, your guess is as good as mine as far as what might happen in the short run. I think longer term, the potential for the 10-year rate to move up substantially is great. And therefore, the rates that you have today, I think based on where they may be in several years, I think are very low. So whether or not you get 2.1, 2.0, 1.9, 2.2, in the long term, it's really not going to make that much of a difference. So I understand your frustration having just missed out on an even better sale, but I still think there's a sale. I think that you're still able to borrow very inexpensively, and one day I think borrowing costs are going to go through the roof, and I think it does make sense to lock in. Of course, if you wait and lock it in the short run, you might end up paying 2.5% as opposed to 1.8. And maybe you won't do the deal at all, and who knows where you'll be. I don't know how badly you need these funds, or what the use of the proceeds is. But in general, I think the rates are low, and they're going to go a lot higher. So whether or not you get the absolute low, I don't know. Maybe you refinance now, and if you get lucky, I don't know what the cost is. If there's any prepayment penalties, you might be able to refinance again. Or maybe sometimes you can get a rate with the bank where you can, if the rates do go down, you get to reset it. I don't know. You can work on that with your bank, or maybe they can work out a deal with you. Because if it was their delay, if that's the reason that the rates have moved up because they were dragging their feet, then maybe you have a reason to complain and maybe beat them down a little bit, get them to take a little bit of a lower profit, because there's generally a lot of profit in these refis for the banks. And so maybe you can beat them down a bit and drive a better bargain and say, look, you guys took so long and now the rates went up. You need to shave this down a little bit, and maybe they can take a little bit of lower profit. It might not offset the whole difference, but it might help relieve the pain a little bit.
David in Bellmore, New York asks, I have gone all in with gold and mostly silver over the last 2 years, as I previously lost a lot in the stock market in 2008. Now my purchase in gold and silver is worth 50% of what I paid. Do I have any chance of my metals going back to the price of 2 years ago? Is it time to buy more or bail?
Well, I don't see how you can be down by 50% unless you just bought all silver and you bought it all at the high. Because even if you bought the absolute high in the price of gold, you're down, what, 20, 25%-ish? So I don't know how you managed to lose half your money in physical market. Maybe you're trading options and you lost there, or you have leverage. I really don't know. So I don't know how you got yourself into this particular bind. And remember, I don't advise that people go all in on anything. I'm not all in on gold and silver myself. I have diversification. I am way overweighted, don't get me wrong, in precious metals and mining stocks, but I am not exclusively in precious metals and mining stocks, and I have never advocated that people are exclusive. Now, for some people, look, if I've talked to younger people, they have $500, $1,000. Can I put all that into silver? Yeah, sure. When you have a small amount of money, it's hard to really build a diversified pool of investments. So I would have no problem with starting with an amount of gold or silver. But if you have a more mature portfolio, you want to be diversified. And I am diversified in stocks and bonds all around the world and other asset classes. But to the extent that you did buy some gold and silver at higher prices and that you're down right now on your purchase, yes, I do believe that if you wait it out, the markets will move higher. I think even if you bought the high, which on gold is around 1900-ish, and on silver it's about $50. So even if you bought the highs, and now gold's around what, 1,500, 1,450, 50, silver is what, $22, $23, something like that. So silver does need to more than double, gold doesn't. But I do believe that the prices are going to go higher. In the meantime, maybe you can take advantage. I know you said you were all in, but I'm assuming that you have a job and that you're earning money, and so you still have the ability to increase your position at the lower price. What I might suggest is the next time there's a significant rally, though, if all you have is gold and silver, and if you have a significant enough portfolio, you might want to take a little bit off the table and build a more diversified portfolio. And to learn how to do that, I would suggest talking to brokers at my company, Euro Pacific Capital. Go to our website at europac.net to get more information on my brokerage firm and my asset management company.
Slate Clifton from Carson City, Nevada asks, precious metals, historically speaking, seem to top out 5 to 6 years after the Dow bottoms out. If the strategy is to get back in equities at the bottom or near the bottom, you have to know where the bottom is. So should we be selling our metal before the top? What should the spot price be for gold and silver to get out and enter stock trading?
Well, I mean, obviously, if you know where the top is, you might as well sell right at the top. Why not? Why sell before? But of course, the problem is we don't know when the top is. So we don't know until after the fact that a top has been in. Now, we have a short-term top that we made in gold and silver. Should you have sold before that top? Well, if you sold very, very near the top, then obviously you did well. But you might have sold years before the top, in which case the market is still higher than where you got out. I don't know, but clearly if you could time it right, yeah, you want to sell the tops and buy the drops, right? Buy the dips. But again, where's the bottom? Well, we don't know until we're looking back at it from higher levels. Have we already bottomed out in gold and silver? I think that we might have. I've been making the case that it looks to me like we're building a bottom, but we don't know for sure. The bottom might not be in. We might be going lower. I don't know that yet. At some point, we'll know for sure, but it's only because we're way above the bottom. And now you can look back and say, gee, that was the short-term bottom. Just like now we know where the top was. I mean, there were people who were speculating that we had a top. Now, there are people who think that the top was a major top, that the top ended the bull market. I don't think that for a minute. I don't think that's happened. But if you're trying to look at gold as a barometer of whether or not you should be buying stocks, I think you should be buying stocks anyway. You should just be looking at the companies and the valuations, not blindly buying the indexes, even if many of the stocks that comprise them are overpriced. I also don't think you should be looking just in the United States. In fact, I think you should be looking mainly outside the United States for your equity opportunities. But it's not either or. I don't think it's gold or stocks. I think you can own both. I don't think you want to go all in on stocks. I think there is the potential that stocks could drop, and so you want to have some dry powder. And I think some of that dry powder is better kept in real money, in gold, even though there's volatility, than keeping it just in fiat currencies. But if you want to look at a measure where I think you want to go all in on equities, or at least if you're going to look at the U.S. stock market as an example, I've been saying 1-to-1 Dow gold. Right now, that ratio is about 10-to-1, 9-10-to-1. So it's nowhere near where I think the bottom could be. Now, do I think we're going to get all the way down to 1-to-1? I don't know, maybe. But if we get 2-to-1, that's probably close enough where you can start really moving your gold out of gold into stocks. Of course, some of that might depend on what's happening in America at the time. If the stock market is plunging relative to gold and we're doing the right thing as a nation, the way we did the right thing, at least, in 1980, the last time this happened, when we had the combination of Paul Volcker with higher interest rates and Ronald Reagan cutting marginal tax rates and talking about government is bad, we need to shrink government, we need sound money. After years of reckless printing and borrowing, that environment might be conducive to a big rally in stocks relative to gold. So you've got to pay attention to the macro picture. Are we taking the medicine? Are we doing what we need to do to fix the economy? If we are, and then stocks are dirt cheap in that environment, then you want to buy them and you want to get out of gold. But I think until we get that confluence of events and prices, I think you want to have gold and stocks, but predominantly non-U.S. stocks.
Adney in Hordaland, Norway asks, there are great oil and gas reserves in the U.S. Do you think these reserves can be used to pay down the U.S. debt?
Sure, they're going to be used to pay down part of it. They're not going to pay it all down. There are a lot of people who think that the oil and gas reserves that we have amount to some kind of get-out-of-jail-free card, that we can keep on borrowing and spending, and we're going to pay for it all with our oil and gas reserves. We're not. Now, it's fortunate that the free market has discovered a way, that individual entrepreneurs have come up with a way to economically harvest these reserves that without the new technology was beyond our reach. So it is a positive development. We would be in much worse shape had we not had this positive development. But it is not, again, a get-out-of-jail-free card. We still have a real crisis coming because of the enormity of our debt and how screwed up our economy is. Yes, the extra oil and gas reserves will help ease the burden, make it easier to repay our debts. And when the dollar loses its value as the world's reserve currency and we have to start exporting to pay for our imports, we won't be able to just print. Having more oil to export is going to be very valuable. Also, to the extent that we have more domestic sources of energy for U.S. manufacturers, when we have to manufacture more things because we can't just print money to buy what everybody else manufactures, having more abundant and cheaper sources of energy is going to be a plus. So I'm not saying that there are no pluses, that everything that's happening is negative. But my point is what's negative is overwhelming what's positive. And so we still have a real crisis on the horizon. But yes, the fact that we do now have more reserves that we can exploit will put a little bit of a buffer, so it won't be as big a crash as it would have been if we didn't have that. But of course, there's always a problem that the government comes in and screws it all up. The government has more rules, more regulations. You got the environmentalists. The government tries to crack down, and so they slow down our ability. And you never know if the dollar really collapses and we start exporting more energy. I can see politicians trying to limit our exports with some kind of tariffs, or basically saying, hey, this is our oil, we need it, we can't sell it abroad, or something like that. It's probably unconstitutional, but that wouldn't stop them. The Constitution doesn't seem to get in the way when the government wants to usurp power. So if we do something like that, we'll undermine the industry. And just because we can't, if we can't export it, doesn't mean we're going to produce it. Because if the Americans can't afford to buy it because we're broke, it's not going to be produced unless it can be exported. So just clamping down on exports isn't going to mean that we're going to have cheaper oil ourselves. It just means that it won't get harvested in the first place. So it'll just, make it worse. So I don't know. I mean, the book hasn't been closed yet on how this is going to play out. So who knows what the government's going to do. But don't make the mistake, like a lot of people have, of just believing that, this is it. This is, it's a free lunch now. This is our salvation. We're going to have this huge trade surplus now based on energy. We can maintain our low interest rates. We can keep on consuming, and it's all going to be paid for with this enormous oil and gas reserve. It ain't going to happen.